Hello everyone, I have a £13,000 plus position that I hold in my stocks and shares ISA on Trading 212. This is a holding that takes up over 25% of my over £53,000 plus portfolio and is one of my biggest conviction stocks. Today I want to talk about this position, why I have so much money and portfolio weighting held in this one holding, and I'll be discussing its most exciting metrics and avenues of growth. Finally, I'll be valuing this company and seeing at what price I'll be adding more to this position. If you enjoy this video, then consider leaving a like and subscribing to the channel to help it grow. So my biggest position at over 25% in weighting in this ISA is a company that at first glance is not that highly margined and is overall not really well known for being that profitable. But that's starting to change in a big way for both. The company is, of course, Amazon, and this is a company I was buying below this $180 mark. And I was saying at the time it was massively undervalued, and I even made a video on it saying it's cheapest it's been in years and possibly a decade. So I really went all in on this company. I bought over 10k at the time before I pretty much ran out of money. And since then it's up by quite a bit, and I still have very high conviction for the chances for this position to grow into the future. And I want to talk about the investment case I have for Amazon and just overall talk through my reasoning with you. And then I'll be carrying out a discounted cash flow analysis on Amazon and see if it looks like from the historical metrics and a DCF that Amazon is a buy still even now. At the top of the list of my reasons to invest in Amazon is their overall brand and customer loyalty. They have worked for years to get an infrastructure in place that means that they have created a very effective e-commerce business that can actually produce amazing next day deliveries for their packages almost worldwide, which is sort of unheard of on the scale that Amazon does so. And this means that there is a hell of a lot of ease of use and overall moat to Amazon. As well as that, generally this gives them a total addressable market that is huge. It's potentially the whole world. So when you look at Amazon, I think it still has amazing great runways of growth, even though it's grown so much in the past 10 to 20 years. Now I get packages all the time from this business, and I think thousands of people from the UK all the way to America do as well. I just love the ease of use with using Amazon. Its next day delivery service makes this almost completely necessary, and it's something that almost no other company or business can provide. But there's more to it than just this e-commerce model. They are now the number one in cloud market space or the cloud provider space, which is their AWS service, and that gives them a dominant market position and a market leading advantage. That means they'll probably be the first point of call for most companies that are looking to use a cloud service provider. AWS will become their cloud service provider, and then they'll have switching costs if they choose to move away from it. So to me, I think AWS is very well placed for its growth, and I think its growth rate of about 19%, which is massive for this business, is still a huge thing. And then we've got their other forms of revenue. We've got their number two in streaming service in the form of Amazon Prime behind Netflix. And I think that Netflix has proved that this space is a massive total addressable market and a massively profitable one if got right. And I think Amazon is well placed to do that in just the same way that Netflix is. But I think that Netflix is overall got only that one source of revenue, whereas Amazon has many. And the Amazon Prime service is still a very good subscription model that is very profitable for this company. And then we've got their number three in advertisement revenue. Now, obviously, they're behind Google in that sort of space, but I do think that this is a sort of understated one for Amazon. They've got a very good ads business that is growing very fast at around 19%, very similar to AWS. This is highly margined and overall is very good for their business model because of the nature of their e-commerce market. So when you add all those things up, I think those are the things I want to focus on. Cloud market space or provider, streaming, and of course their advertisement are all very highly margined. And that is comparable to their e-commerce side of the business, which is low margined. So the low margin part of the business is actually now still a big part of their revenue, but is becoming less and less their main source of revenue, because these other sources of business revenue in these three categories are actually growing quicker than their e-commerce side of the business. And I think this will carry on happening so long as they continue to grow faster in these areas of business rather than their e-commerce business. And that will in turn lead to better margins and growing profitability, which is all a bonus because they now have better and more predictable free cash flows and perhaps have a future for rewarding shareholders like me. So there is my investment thesis for investing in this company. They are flipping the switch on their profitability. Their operating cash flow is increasing at an extremely fast rate, to over 27% CAGR over the past 3 years. And their free cash flow is not likely to see these minus amounts like they did in 2022. I think that's rather unlikely, and I see this margin expansion that they are getting in terms of their revenue streams will likely result in this highly profitable business in the future. But that's just my perspective on it. I think this will continue to grow in its intrinsic value over the years. That's why I've got such a large holding and position in this company. And I think it will continue to outperform the market for the next 5 to 10 years. What about the valuation of this company? Is Amazon trading at a good price? Well, firstly, I like to look at historical metrics to get an idea of how the company has been valued in the past in terms of its metrics. And one of the things with Amazon, I would say, is free cash flow is very unpredictable and has been in the past. So it's not the best metric to use in terms of historical metrics, looking at how the price of Amazon is looking right now. But operating cash flow is a lot more stable for Amazon. It actually shows a better picture, I think, of how the company should be valued maybe. And it's the one that's been most closely linked to the share price in the past 10 years. We can see this is currently trading for a price to operating cash flow of 21 times, and the average over the past 10 years has been sitting at 26 to 27 times. So overall, this actually looks like quite a good metric for Amazon and signals undervaluation because it's under their 10-year average. When I was buying, they were closer to about 17 to 18 times price to operating cash flow, and that was lowest it's been in about a decade. And now, even at 21, they're still the lowest it's been in years. And we can see that it hasn't actually sat at that level since around about 2017 or 2016. 2020. So the reality is that this business is still not overvalued. It's still undervalued by this metric, if you ask me. Now we can try and use this metric to see if we can find out a fair value for Amazon. Now, if we use their operating cash flow rather than their free cash flow, and we look at a 5-year time frame, I like to be more pessimistic than optimistic when predicting free cash flows into the future, because the further into the future you go, the less reliable this sort of metric can be. But they sit at a 5-year average of around 26% in growth of operating cash flow. If we just say they're going to grow this by around 12%, which is under half of that overall growth rate in the past 5 years, so is still massively conservative. And we allow for a slight dilution of shares, as is Amazon's MO. And then we change the price to operating cash flow, which has been trending down in the past couple of years, now sits at 21. If we change this to around 23, which is still under the 5-year average, then we get a fair value for Amazon at $253 per share and a CAGR over the next 5 years of around 12%, which is a market-beating return. And these are conservative estimates, if you ask me, and it's still signaling a buy for Amazon. Now, where we can play around with this a little bit more is if we believe this operating cash flow, as I do, is going to grow quicker than this, and we say 14% instead. And we keep that average price to operating cash flow of 23, which is still below their 5-year average, but I still believe is maybe conservative if it trades at its averages. Then we get a fair value for Amazon of $276 per share and a CAGR of around 14%. So to me, I would expect, even on these conservative estimates of growth rate and operating cash flow, that Amazon is likely to grow at a market beating return of around 12 to 14% CAGR over the next 5 years. Obviously, that doesn't allow for that much margin of safety, and I do believe that when I was buying $180 per share, that was maybe a better entry point. But I do believe that Amazon is still a buy right now, and I would consider adding to my position. My main reasoning for not doing so is because I've seen other better opportunities, and I haven't got that much available cash in my portfolio right now. But what do you guys think? Do you like Amazon as a business? Do you think it's a buy right now? Let me know down below. And as always, thanks for watching. I do appreciate it, and I'll catch you in the next one.